Imagine turning a $10,000 investment into more than $160 million. That's not a myth. That's what would have happened if you invested in Warren Buffett's company, Berkshire Hathaway, in the 1960s. But here's the real question. How did one man, without trading daily, without chasing trends, become one of the richest people in history? And more importantly, what can you learn from him, even if you're starting with just a few dollars? Welcome to Crown Global, and today we're breaking down Warren Buffett's investing principles, explained in simple, beginner-friendly language. These lessons can literally change how you invest for the rest of your life. So grab a notebook, because this video might be the most valuable financial lesson you hear today. Who is Warren Buffett? Before we dive into the principles, let's set the scene. Warren Buffett, also known as the Oracle of Omaha, is considered the greatest investor of all time. Not because he made one lucky trade, but because he mastered long-term, disciplined investing. He started investing at age 11, bought his first stock for $38, lost money at first, learned, improved, and now controls a company worth over $900 billion. But here's the magic. Buffett's approach is so simple. Any beginner can follow it. Let's break it down. Principle number 1, invest in what you understand. Buffett's first rule is shockingly simple. Never invest in anything you don't understand. He avoids complicated businesses. He avoids hype. He avoids things he can't explain in one sentence. If you don't know how a company makes money, if you can't explain why it will grow, if the business seems confusing, don't invest in it. This rule could save beginners from 90% of common mistakes: crypto hype, meme stocks, pump and dump schemes, and overpriced tech trends. Example: Buffett avoided many tech companies for decades because he didn't understand them. But when he finally learned how Apple's business worked, he invested, and it became Berkshire Hathaway's most profitable investment ever. Principle number 2, buy wonderful companies at fair prices. Buffett famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." A wonderful company means strong brand, loyal customers, consistent profits, good management, a product people will buy again and again. Examples Buffett loves: Apple, Coca-Cola, American Express. Beginners often make the mistake of chasing cheap stocks. But cheap doesn't mean good, and expensive doesn't mean bad. Buffett looks for companies that will still be great 10, 20, 30 years from now. Principle number 3, think like an owner, not a trader. Buffett isn't a trader. He's an owner. He buys companies the way most people buy houses. With research, with confidence, with long-term commitment. If the stock price goes down tomorrow, he doesn't panic. He doesn't sell. He doesn't check the price every hour. He focuses on the business, the long-term profit, the future potential. This mindset protects beginners from emotional decisions. Principle number 4, the power of compound interest. This principle is the fuel behind Buffett's wealth. My wealth has come from a combination of living in America, some lucky genes, and compound interest. Compound interest means your money earns money. Then that money earns money. And it keeps growing. Buffett became a millionaire at 30. And today, most of his wealth came after age 60. Because compounding is slow at first, then suddenly explosive. For beginners, start early. Invest consistently. Let your money grow. Principle number 5. Be fearful when others are greedy. This is Buffett's most famous quote. Be fearful when others are greedy, and greedy when others are fearful. Most beginners follow the crowd. If prices rise, they buy. If prices fall, they panic and sell. Buffett does the opposite. When the market crashes, he looks for opportunities. When everyone is excited, he becomes cautious. This mindset protects you from emotional investing and helps you buy low instead of high. Principle number 6. The margin of safety. The margin of safety means don't pay full price if there's risk. Example, if a stock is worth $100, Buffett wants to buy it at $70 or $80, not at $100. Why? Because the future is uncertain. Anything can go wrong. So leaving a margin protects your investment. For beginners, this means avoid buying during hype. Wait for discounts. Don't rush. Patience is a superpower. Principle number 7. Avoid debt and stay liquid. Buffett dislikes personal debt. He avoids credit card debt. He avoids high-risk loans. His philosophy: if you're smart, you don't need debt. If you're dumb, you shouldn't use debt. He always keeps cash available because cash is power. Cash allows him to buy opportunities during market crashes, stay calm, take advantage of big discounts. Beginners should build an emergency fund before investing. Principle number 8. Stay disciplined and ignore market noise. The stock market is full of distractions. News headlines, predictions, hype, rumors. Buffett ignores all of it. He focuses on businesses, not noise. He spends most of his time reading, thinking, and waiting. Beginners often lose money because they react too quickly. Buffett makes money because he reacts slowly. Principle number 9. Focus on long-term, not short-term. Buffett's favorite holding period? Forever. He buys companies with the intention of holding them for decades. That's why he avoids trendy stocks, speculative bets, day trading, quick profits. His belief is simple: long-term investing always wins over time. Principle number 10. Invest in yourself first before investing in stocks. Buffett says, the best investment you can make is in yourself. This means improving your skills, becoming more valuable, learning new things, increasing your income, developing discipline. Your mind is your biggest asset. Practical steps for beginners. Here's how to apply Buffett's principles today. Step 1. Learn the basics. Step 2. Only invest in companies you understand. Step 3. Look for strong brands and long-term stability. Step 4. Ignore market trends and emotional headlines. Step 5. Invest regularly no matter the market. Step 6. Hold your investments for years or decades. Step 7. Diversify slowly and wisely. You don't need to be a genius. You need patience, discipline, and time. Conclusion: Warren Buffett became wealthy not because he took crazy risks, but because he followed simple principles consistently. He mastered patience, discipline, long-term thinking, understanding businesses, avoiding emotions. These principles can work for anyone, yes, even beginners. You don't need millions to start. You need the right mindset. If you found this video helpful, make sure to like this video. Comment below, which Buffett principle do you want a full video on next? Subscribe to Crown Global for weekly videos on investing, personal finance, and wealth-building strategies. This is Crown Global, where we help you grow smarter, richer, and more financially confident. Thanks for watching, and I'll see you in the next video.